S&P and NASDAQ record highs, Treasury yields dipping just a bit this morning ahead of next week's Fed decision. Our next guest is in charge of corporate credit over at Goldman. Jonny Fine's here at Post 9 this morning, Goldman Sachs Global Head of Investment Grade Credit, to talk about markets and a lot more. Great. Thanks for coming in. Good to see you.
Thanks for having me.
We saw the quarter. We're still talking about how powerful the quarter was, and we can sort of see what's happening with capital markets activity. How does it feel right now?
It feels very good. As I look across all of our capital markets franchises, we're seeing bursts of activity. In my world in investment grade, it's been consistent all year. We're running at or near record highs, both in the US market as well as in the Euro market as well. The Euro market continues to have a higher share of global financing than it's had historically, so we're seeing a diversion of capital markets flows there. Very exciting, especially as US corporates look to finance in lower yielding markets around the world. Highly active, and the outlook remains very robust. Leverage finance, also very robust. A lot of activity going on, a number of loans announced in the market yesterday. Things feel wide open, and a real burst of activity in US IPOs as well. So as we look across the full breadth of our capital markets franchise, I think with a lot of the policy mix now in the rearview mirror coming out of the administration, obviously some still things to iron out, but we're in late innings, and it feels like the path of least resistance is continued robust activity overall.
Are issuers or potential issuers counting on Fed cuts this year?
So I don't think the answer to that question is yes. I think that there's more or less alignment with how markets are pricing in, maybe a kind of couple cuts through to the end of the year, maybe some more cuts as we move into 2026. I think there's a little bit of consternation in the issuer community that we continue to have elevated term yields in the US Treasury market. We still have a decent chunk of term premium embedded in Treasury yields, around 80 to 85 basis points as it stands right now in 10-year US Treasury yields. And that's, I kind of view it, and I've said this on this show before, it's a real tax. And that term premium is a tax on mortgage rates. It's a real tax on corporate borrowing rates. I think it's been impacted.
US government debt costs too.
And government debt costs, obviously, and it's impacted by the supply of government debt, and it's also impacted by the noise around the potential removal of the Fed chair as well. So those things, I think, really driving, I think, some of the chatter around the corporate circles.
Do you think the question about the Fed chair is showing up in the bond market?
I do. And I think that we saw the market really showed its hand in terms of where it moved for 45 minutes when everyone thought that the firing was imminent. We saw the shift in the yield curve. But we've seen a consistent rise in term premium back towards the highs that we saw at the very, very beginning of the year. I would argue that a good 20 to 25 basis points of that term premium is embedded from the noise around the potential change in Fed chair, and probably prognostications that as we see future FOMC meetings unveiled, we're going to see more dissents than we have done typically, and I'm not sure that the market is in love with that as a concept.
So is that it? Are we just going to see riskier debt, U.S. debt, for the foreseeable future?
I think the path of least resistance in treasuries is towards a steeper curve again. Yeah. And so even though I think the balance of supply in the treasury market is still going to be much more concentrated in the bills market, which, by the way, is easier in a high yield environment than if we get another 50, 100 basis points of cuts from here, then I'd start to be kind of a little bit focused on the things that we've talked about in term treasury markets with respect to tails, bid to cover ratios, start to look at what are there any kind of things going on in funding markets, in T-bill markets and so on that should give us pause for concern. I think that's more of a focus for 26 when we're 50, 100 basis points lower in yield. But no, I expect treasury financing to continue to be fairly concentrated in short duration markets.
But Jonny, do you think the bond market then is already reflecting the expectation, let's assume Powell serves out his term, that his replacement will not be as independent as is currently the case and has been the case certainly?
I would say markets are pricing in a higher probability of there being a smaller degree of consensus among FOMC voting members. We've seen dissent under the Powell stewardship of the Fed 1.4% of the time. We saw that around about 11% of the time in the Volcker era. I'm not saying that we're going to go back to that type of level of dissent, but I actually think dissents are going to become the new norm.
Why is that bad?
I think that we've become so conditioned to having this consensus view of really going into every Fed meeting with a very, very high level of expectation of exactly what they're going to do and a very kind of close circle around what they're going to say as well, that putting some dissent around that, I think creates an incremental level of uncertainty, and with uncertainty comes volatility, and with volatility comes incremental risk premium.
Was the Volcker era the highest for dissents, at least as we're currently aware? Do you know?
I mean, I'd have to consult the history books to go back a long time.
Well, that was an interesting thing you plucked out there, 11%.
Although
Obviously, that was during an incredibly volatile time where there's a lot of debate about how high rates had to go to potentially shut off inflation.
And we get dissents pretty regularly in Europe, right? That's not a big deal in Europe to have a split vote.
It's not. I would agree. So ECB, we do tend to see kind of more dissenting voices around this overall, but that's now become wired into the market norm. I don't think it's as yet become wired into the market norm in the US. I would argue that vol is probably priced too low for what this might look like as we roll things forward for the remainder of this year and into next.
Finally, does it feel like we dodged a bullet out of Japan, the markets that is? Ex-election, post-election?
I think so.
Yeah.
Kind of look at how markets have reacted over the course of the last 48 hours or so. It kind of feels as though business as usual. Certainly as we kind of think about level of equity market activity, ongoing capital markets activity, I continue to kind of feel in most of my conversations with like major corporate issuers, we have a very good financing window. We're in the bottom 1% of credit spreads over the course of the last 2 decades. It's a pretty attractive environment overall, and if you subscribe to the view that volatility and risk premium may rise as we roll forward into a new Fed era, then that probably means it's a good time to continue financing and come into market.
Sorry, I'm just grokking this. Looks like William McChesney Martin stands out as a candidate with the most dissents, but that was because regional Fed bank presidents used to vote at every meeting, so there were more votes. But still, that was
what period? When was
50s,
when was he chair?
50s, 60s, early 70s. It was a period of actually contentious inflation, and there was a lot of political pressure.
Yes,
on it.
absolutely.
And we'll see if Powell remains on the committee post chairmanship.
True. Another question.
Jonny, good to see you.
Great. Thanks for having me. Great to see you all.
Thanks,
Thank you.
Jonny.